Portfolio for an Inclusive World webinar. We are expecting nearly 80 funders, nonprofit organizations, and others who support the field to join us this afternoon. I'm Alex McCrae, Senior Director of Programs at Philanthropy Massachusetts. We appreciate the work that went into planning this webinar. I'd like to thank Sonia Kowal of Zevin Asset Management for her leadership in assembling a panel working in the investing space. Thank you to Erica Seth Davies and Julianne Zimmerman, who you will hear from shortly. This webinar will highlight approaches in building an investment portfolio with a focus on racial and gender justice and supporting equitable economic development. Later this year, we will host another webinar that focuses on implementation. Here are just a few Zoom housekeeping tips, if you will. All participants are muted to enhance the audio experience and facilitate all presentations by our speakers. The presentation portion is approximately 40 minutes long, with a few pauses to take questions that surface throughout our time together. Please type your questions into the Q&A box, and I will read them aloud. We greatly appreciate that. For any technical issues, please also use the Q&A box. Lastly, we're recording this webinar. After the session, we'll send you a link to this recording. With that, I'll hand it over to Sonia.
Thanks, Alex. So we're thankful to Philanthropy Massachusetts as well for hosting this important webinar. And today you'll hear from some of the leaders working at the intersection of impact investing and gender and racial justice. So in terms of the agenda, Erica is going to set the stage for us and discuss how foundations are uniquely poised to address these issues. And then she'll pass the baton to me, Sonia, after about 10 to 15 minutes. And I'm going to describe how foundations can integrate gender and race in the context of the public equity portion of their investments. And then Julianne will complete the conversation with a discussion about the benefits of making direct investments in companies led by women and people of color. And she's going to be doing some myth busting about the exciting opportunities she sees for investors in that space. And although we're not going to go through them, at the end of each section, we've got resources that you can use to further your knowledge of the space. So please feel free to ask questions, as Alex said, in the chat function. Alex will ask them at the end of each section, and then we've also left some time at the end of our prepared remarks for further questions. So we're all here today because we believe that societal changes on gender and race issues are critical. So if you really believe that, I'm going to challenge your foundation to put your money where your mouth is. And I mean your investments and not your grant money. It sounds pithy, but be that change you want to see. And today we're going to learn about the powerful investment reasons for doing so. So this is about good and smart investing rather than a nice to have. So that's really the main message to take back to your investment committees. For too long, investors have willfully ignored the critical role of race and gender in their portfolios, the exclusion of women and people of color from the ranks of investment professionals, and unequal access to capital markets for entrepreneurs who aren't white men. And ironically, that includes many foundations whose missions are dedicated to dismantling structural inequities based on race and gender. So today we're going to talk about the steps involved in changing that. And so with that, I'm going to pass it over to Erica.
Okay, thank you so much, Sonia. And Alex, thank you for having me. It's a pleasure to be here this afternoon. And I am just thrilled to be presenting with Julianne as well. So let's just jump right in to the discussion. You will, I think, get everything afterwards, so there's no need to go into my bio, but probably the most significant part of the work that I've done, excuse me, in the last few years that was insightful for me in understanding how foundations could really be change agents with this work was an initiative that I led at AFFE, the Association of Black Foundation Executives, that really started to look at the diversity of asset managers, looking at endowment practice, again, through a DEI lens. So next slide. So one of the basic principles of doing equity work and advancing justice is to make sure everyone is operating from a place of shared understanding, and that we're all on the same page regarding our definitions. And so just wanted to start the conversation with a really quick look at what do we mean by racial and gender lens investing, because it can mean something different to everyone, and all of those things can be true at the same time. So I actually grabbed a basic definition or I guess example framing for this from the GIN, the Global Impact Investing Network, had an excellent summary of what that looks like in terms of gender lens investing, and I think it's certainly relevant for racial justice investing as well. And so I have provided some highlights from that definition. So it's investing with the intent to invest directly in Black, Indigenous, and people of color owned, or women-owned enterprises. It's also investing in those enterprises that promote workplace equity, for example, and that can be in staffing, management, board representation, or along the supply chain. It can be investing in enterprises that offer products or services that substantially improve the lives of Black, Indigenous, and people of color, or women and girls as well. So that's, when thinking about direct investments, but it can also be in terms of process and strategy. So a process that's focused on equity. So it could be around pre-investment activities, sourcing, due diligence, or post-deal monitoring, like strategic advisory or exiting from a strategy. And then that brings us to strategy as well. So a gender lens or in a race lens investing strategy can be looking at the vision and mission of, investee enterprises, the organizational structure and culture, policies, workplace, et cetera, use of data and metrics, and then how financial and human resources are overall committed to gender and race equity. Next slide. So with that in mind, that it covers a lot of ground, but I think that actually creates the opportunity. So instead of either or, you all of a sudden have this both and an expansive space in which to operate. It's no longer some limited way of thinking about how to do this work, and that applies across the spectrum of capital that foundations tend to have at their disposal, from grants all the way to market rate investments. But why would this matter, right? So why is this something that we should be thinking about and spending time on? And I think if you're on the call, for the most part, you're at the very least bought in or curious, and we'll take that too. But I think just there are many reasons, but some of the ones that I have found to be most resonant with the foundation community include DEI. Right? This is just another way for foundations to align their work with their mission, so that it's not just in grant making, it's not just in operations, but it's in the corpus. Maybe it's looking at the most significant asset of foundations, that 95% that makes everything else go. So when your endowment is lined up with your mission, you're hopefully not investing in things that actually make your philanthropy necessary. And that also includes the way in which we're thinking about inequity in this country or even globally. Shared prosperity. So I used to talk about the wealth gap, but I think I didn't want to talk about it in terms of deficits. And so shared prosperity is just another reason and another opportunity that can be addressed with the ways in which we approach our investment strategies. So it can close the wealth gap. You do potentially create actually new classes of investors. You're having the opportunity to, again, be intentional about building wealth in communities of color and among women. And so it's actually getting to some of the most seemingly intractable issues in our society around wealth and prosperity and economic stability. Leadership pipelines. One of the reasons that it's often difficult to move this work at the foundation or the board level is the lack of diversity in decision-making roles. And when we're investing in these opportunities in entrepreneurs and in asset management firms and all the different ways that I mentioned before, you're actually starting to build even more robust leadership pipelines for the corporate board sector, for the nonprofit sector, and for foundations as well. So these are your future committee members and trustees, and even for some foundations, community foundations in particular, your future donors, which leads us to philanthropy. In a very brief look at some of the investing or some of the philanthropy that was done by Black-owned asset management firms a few years ago, I think I had tallied up something like 65 million that came from about 4 or 5 firms alone. We know that there is tremendous potential for wealth creation in asset management in particular, but when entrepreneurs are supported and developed, then that just creates more opportunity for philanthropy across the board. Excellent. But thank you. So why does it also matter to like foundations? All right. So what is the benefit to an institution for taking this work on in this way as well? So those are sort of the social benefits. But for the sector and for foundations in particular, when we're talking about, for example, asset managers or investing in venture or direct investments, there's the opportunity for alpha. So, and you'll hear about this later on, the performance is absolutely there. And the data bears that out. It's just whether or not we are paying attention to supporting, ensuring that different firms and businesses have the capacity that they need to be successful. And we all see, you will see the results speak for themselves in that regard. Diversification, you're spreading the money around, spreading the wealth around as well. So that, again, creates the opportunity to hedge against different, for the most part, this is usually an asset manager conversation, but just creates different opportunities in the market to, again, spread resources so that we're not over-investing in one particular type of firm as well. And then diversity. Everybody cites the McKinsey report. There's a ton of reports on what happens when women join boards and how performance increases and how the profitability of corporations that actually have more diversity in decision-making roles compares to those that don't. But I'll say it again, diversity gives you better results. And that applies in terms of the investing strategy as well. And finally, in terms of capacity, it's important that we're building next generation of opportunity. Firms and businesses that are owned by women and people of color tend to hire women and people of color as well, tend to groom opportunities for leadership for women and people of color. So it's an overall opportunity to, again, expand capacity and build capacity in different sectors in our field as well. So why isn't this happening if it's such an amazing and opportunity? Excuse me, we can go to the next slide. Usually, like I said, I try to do the asset building, but we'll get there. But there are barriers, right? And just being honest about it, that in the field of philanthropy, which is what we're talking about in particular as investors, foundations as investors. Some of the barriers and most common ones that I've seen over time include some of these that I'll review really quickly, but they tend to be connected to policy practice and cultural representations. So when we're talking about structural barriers, those are where they are tending to be connected, that create these really difficult and seemingly insurmountable barriers for opportunity. But if you're aware of them, then you can start to chip away and dismantle them. So when there's no institutional commitment to DEI, it's very hard to make these types of investments or make the case for why these types of investments should be made. When we are using seemingly race and gender neutral policies and practices, you're going to get actually racialized results, and you're going to get results that are not gender neutral. So you've got to unpack and understand if we want to have a targeted outcome or a universal outcome, even we've got to target resources in a particular way and name the things that have been preventing equity in the first place. There tends to be a misperception among decision makers and consultants at times of a higher risk, higher business risk and higher investment risk when working with diverse-owned firms or businesses. And that is actually tied directly to the lack of diversity among decision makers. And so if the experience of everyone around the table is one of working with other white men, either around that same table or in their networks, that's reinforcing a particular bias. And speaking to cultural representations, the idea that, oh, if I invest with or if I support someone who's different from me, then that's a riskier proposition simply because you don't know them. Again, with the limited diversity at those seats, among those seats at the table, there's just simply a limited exposure and access to the networks where greater diversity is going to exist. And again, that's going to feed into bias. So we're all brought up into society and we all have our bias. And so if we're not aware of it, that's leading a lot of decision making. And again, the things that are happening around us are reinforcing that bias. We talked about echo chambers. People talked about echo chambers before, and that will feed into your bias as well. So if that's not checked, that just becomes a barrier because those biases are actually informing decision making. And then finally, there are gatekeepers in the system that, based on business model and where opportunity sits, that it's most advantageous for them to maintain status quo. And again, those other features in terms of commitment to DEI in some of those places or lack of diversity, again, we just have this self-perpetuating cycle that doesn't lend itself to change. Okay. Next. All right, so what does need to be in place and what can we have in place? And for the conditions for success, one is, yes, just a commitment to DEI. When I say institutional commitment, I just mean like that the institution has said this is significant, this is important, and we are leaning into diversity, equity, and inclusion in the work that we do as an institution. And that means that the board, committees, staff are all understanding that this is who we are as an institution and this is what we're doing. It makes it a lot easier to recommend these changes or to recommend these opportunities when people are at the very least bought into the value of diversity. Having shared language and understanding, again, within the institution and within the frame of whatever piece of the strategy or the approach that you're taking, making sure that you're looking at your policies and practices through a DEI lens. There's something called a racial equity impact assessment that will help you actually sort of mitigate bias and take your programming and your policies through a set of questions that help to frame a better outcome or a different outcome based on the audiences that you hope to reach. Making sure that you've got a structural analysis and understand root cause. So as I mentioned before, policy, practice, and cultural representations are the things that are moving together that create those barriers. But when you start to understand them and you have a systemic view, you will see how these things play into each other and how some of the interventions that we would hope to see in one place will have a different effect someplace else. But it's more of a total picture of what's going on. And when you have that root cause analysis, some of the decision making or the recommendations that may come to be able to address your race or gender lens investing, they make more sense. So just an example of that would be, because of the racial wealth gap of very many Black businesses don't have opportunity to a friends and family round to raise resources. And that's just rooted in a whole lot of history. But when you come to understand that, then you realize that there are things that have to be done along the way to become a friends and family round for people who, for discriminatory policies and a history of discriminatory policies and practices, were not able to build wealth in their community in large numbers. So your problem solving, your solution, your recommendations are going to be different when you understand a root cause analysis. Making sure there's diversity among the decision makers. I always say that diversity is essential, but it is not sufficient to move equity. But you do have to start somewhere, and that's the most important place to start, that there's a diversity of perspective and experience that's at the table. Data, you'll hear more about the importance of data later on in both of these presentations, but making sure you've got good, solid data and that you're disaggregating your data by race, by gender, by geography. The same things that very often apply to racial equity grant making apply here as well. And then ensuring that there are metrics and there's accountability for the work that you want to get done. So, power analysis can be useful at this stage of the game, but if you're working with a consulting firm, making sure you're holding them accountable. If your board is working through a investment committee, making sure that they're holding them accountable for the decisions and for the process and for the policies that are going to move a different outcome. I won't do too much around putting pieces together because I want to get to the other presenters, but I will wrap up with a growing opportunity now, because sometimes there are things that you can do from where you sit that are going to start to move the needle a little bit, at least in the audience that you're working with and the networks that you have access to. So just making sure that you're intentional and explicit about the policies or even your practices around inclusion. And if you are not able to move an entire committee and board to change policy, just know where in those policies there may be barriers being created. Connecting this effort to performance appraisals for staff and or consultants, that's something that can be done in the short term. What gets measured gets done. Or gets managed, one or the other. But it's really important that you hold people accountable for the results that you want to see, and that they know how serious your leadership is around getting this work done. Explore platforms that are offering exposure to Black, Indigenous, people of color, and women, managers and entrepreneurs. They're out there, and that'll be in the resources that we share later. Some of those platforms where you can find those types of managers or those types of entrepreneurs where they come together in affinity spaces. Again, monitoring your relationships with your consultants, asking the questions about how they're working, not just with you, but with some of their other clients and the results that they're getting from their other clients. Are you, in terms of asset managers, for example, are you promoting or encouraging other clients to work with diverse firms as well? How many have you recommended in the last year? How many are you working with? So this kind of gets to some of those questions around data. Again, knowing those affinity groups that are supporting racial and ethnic and gender entrepreneurs, and attending the conferences and events that are focused on those groups as well. There are plenty around the country every year. Once we get back out here to be able to go to them, you could actually do an entire year of conferences and networking events and just be astounded and amazed and awed by the talent that's out there that did not know, very often people did not know exists. Encourage collaborative business models and partnerships. If you're working with a consultant, make that consultant work with a fund-of-fund or manager-of-manager platform. So if they don't have exposure to the types of firms that you want to see, make sure that they are partnering with those that do. And then always be on the lookout to recruit diverse talent for your boards, for your committees. Some people can, if you're on a panel, say, look, I'm not doing this panel unless there's diversity on this panel, or making sure that the host committees are diverse. So there are a number of things that you can do to start moving the needle now from wherever it is that you sit. So with that, I'm going to put myself on mute and listen to my and their brilliance. Thank you.
Thanks, Erica. All right, so I'm going to dive into how foundations that care about race and gender can implement these issues into the public equity investment portfolio. So I'm the president of Zevin Asset Management. We are a Boston-based manager, and we are majority women-owned and led, and we're a B corporation. Our staff are 50% women and 40% people of color, and we've been socially responsible managers for over 20 years through our global multi-asset and public equity strategies. So as most of you know, the largest piece of your portfolio is probably going to be your public equity allocation. And while the impact in investing these assets with a gender or racial lens might not be quite as direct as with venture or private equity, there, small changes at large corporations can really have huge repercussions on wider society. So I think, as Erica noted, seemingly neutral policies aren't. So it's important to note that either your advisor and manager does look at gender and race when they invest, or they don't. So either you've given them a remit for your portfolio to take these into account through your investment policy statement, or you haven't. Of course, there's always those managers that say they are doing something, but they aren't really, or the impact isn't really there, but that's a discussion for another day. And for the purposes of this conversation, I ask you to think about your mission. And if you're not losing anything in terms of investment performance, why wouldn't you ask your advisor to take some of the steps that we'll discuss today to help activate more of your assets towards your mission? So what does your manager look like? Who owns that firm? Who does the investment? And typically the answers to both of those things are white men. The financial services industry historically has not been a very safe place for women or people of color, although in select areas such as impact investing, that has changed somewhat. That being said, many minority-owned managers feel that they can't do impact investing, or it's a bridge too far because they're already swimming upstream. So I'd ask you to reward the ones that do and try and make space for them in your portfolios. There are many funds and strategies that now explicitly brand themselves as having a gender or racial lens, and that's especially true for gender. But I think it's really important to make sure that that's not just marketing. Make sure that their investment process and proxy voting practices take these issues into account. And I'd give you an example of the much publicized gender diversity SHE fund from State Street. They typically vote against shareholder proposals that promote gender diversity and pay equity. And that makes me question their commitment to the area, because they are voting against the very initiatives that can help address gender inequality in corporate America. So have a look at your own proxy voting record and what you're voting for and against. And then some managers, like my firm, Zevin, go beyond intentional proxy voting to also prioritize shareholder engagement on race and gender-related issues. But that being said, there is a complex interplay between race and gender, and as well as other issues like climate, the general environment, or worker health. And so we think that all these issues should be looked at together to get the most information we can. And I'm going to take you through the gender and race lens in turn, so you can better understand how this concretely plays out in a portfolio. So investing to promote gender equality is a leading priority of many investors already. At the start of 2018, investors who considered a gender lens as one of their criteria was about almost $1 trillion of assets. So that's more than double what was identified in 2016. So there are already a lot of investors doing this, and it's growing quickly. To me, gender lens and racial lens can help investors more closely understand corporate risk and opportunities, and now goes beyond the easy box ticking of diverse boards or senior management, important though those metrics may be. For example, when we make decisions about whether to make an investment in a company's stock, one of the things we look at is pay equity. So pay gaps are typically driven by discrimination, either implicit or explicit. So the first step is to own it and then do something about it. And we're also interested in the hiring and retention of women and other diverse groups, reporting on that, and then setting goals. Because typically women will enter a firm at the same level as men, but then they end up dropping out at every level. So what's going on there, and what are companies doing about it? That's interesting to us as investors. And what about the role of mandatory arbitration in allowing workplace harassment to persist? And as investors, we think that's an interesting data point, and we're trying to track which companies are using it so we can ask them to stop. And there's a substantial growing body of research, like Erica said, that demonstrates that business case for investing in gender equality. So those, companies with greater representation on their boards and senior management are likely to have higher profitability and produce better returns than their less diverse peers. There are also some interesting correlations that show up between women, or they show that companies with more women in IP decision-making roles have more innovations and also better HR policies. That doesn't necessarily mean causality, but investors still need to be aware of that. So I hope you can see that these kinds of issues around gender should be part of good investing, but many managers aren't yet set up to take these factors into account in their research processes. So moving on to race, after all, our economy was built on the backs of Black and brown people. So finance has an important role to play to turn this around. We also believe that mass incarceration is racial injustice, and the private sector is really key here. So in terms of screening, not investing in prison owners and operators is just the bare minimum. As a SRI firm, we don't invest in weapons companies. So we screen out General Dynamics, for example. But it also turns out that they're building ICE's detention center database, something that our clients want no part of. And we've also analyzed mega banks like Wells Fargo and taken a pass for SRI reasons. Turns out that that's also a good decision from a racial justice perspective as well, because of their record in prison financing, predatory lending, etc. And going beyond the criminal justice system, DEI practices in corporations are pretty interesting. There's that McKinsey study shows that diverse companies are going to have above average financial returns. And we can see that in tech companies. So tech companies rely on their ability to find and hire talented individuals whatever they might look like. And companies that fail to recruit and retain diverse talent because they have a poor approach to diversity and inclusion can face material risks. Poor representation and hostile cultures drive turnover among women and people of color there. And that can increase their training costs and human capital costs. And then workers that have faced discrimination can also raise legal claims. So companies that fail to scan that market for underrepresented workers, we feel are at a disadvantage in the cutthroat competition among tech firms for new talent. So as you can see, there's this lack of strong DEI practices at many tech firms, and that can rapidly become a financial issue with material consequences for a stock over time. And attention to racial justice informs the whole integrated research process, right? So we're giving credit where companies have positive practices on DEI, where they have inclusive products and they show evidence of economic empowerment. And we're flagging priorities for improvement as well, such as the work that we're doing on racial pay gaps at TJX, Kroger, and Costco. I'll go into that a little bit later. And we're also asking companies to address working conditions for low-wage and contract workers who are disproportionately Black and brown. And it was interesting, but not surprising to see that companies with better corporate responsibility practices outperformed their peers in the first quarter, a tough quarter for a lot of companies, obviously. This was also true in 2008. And so if you treat your workers as disposable assets, they're going to act like it. But those companies that actually treat their workers as essential will be able to weather the situation better. And that's something that the market has figured out. So these are just some examples that investors can take in the public part of their portfolios to consider and impact racial justice. So I just wanted to take the last few minutes of my presentation and focus on some examples where shareholder advocacy has made a difference to women and people of color. And I'm going to start with paid family leave. So for those of you who have children, consider the reality of the following statistics. 1 in 4 new mothers returns to work just 10 days after giving birth because they don't have any other options. So 25% of new mothers go straight back to work. When I had my baby, I could barely walk 10 days afterwards, never mind be a functioning part of a team. And we know that paid family leave promotes gender, racial, and socioeconomic equity, along with better workforce attachment and public health. Paid leave raises the probability that mothers return to employment later, then work more hours and earn higher wages. It's also linked to reduced infant mortality. It's also a win for companies, right? It improves employee retention and morale. So we took these arguments to companies, and we're excited to see that a number of really large firms such as Starbucks, CVS, Walmart, and TJX took our advice to heart and significantly improved paid family benefits for their employees. Not just birthing mothers, but fathers as well, and non-birthing parents. So I also wanted to show you some current advocacy around DEI as well as pay gaps. So we talked a little bit about big tech firms, and they profess to understand that diversity is key to managing risk and opportunities. And CEOs like to say that inclusion is mission critical. But what we're seeing on the ground is many of them have been unable to improve inclusion in their businesses, and they're beginning to run into risks and controversies as a result. So Alphabet, the parent company of Google, remains predominantly white and male. And they've got really high attrition rates among Black employees. And we think this is really risky for the long-term future of the company, so we're trying to do something about it. In our research, we found that just about the only thing that actually works to improve diversity at large corporations is when executives are incentivized monetarily to meet goals around hiring, promotion, and retention. So some companies already do this, Unilever, Pepsi, and Microsoft, for example, but others need much more of a nudge. So at Apple and Alphabet and Amazon, we filed shareholder proposals over the years to highlight that business need to do this and to urge them to put measures in place, and are starting to get some traction over this accountability issue. And pay equity on race and gender is also an issue where we think investors can make a really big difference. And we're concentrated on the retail sector, where wages are low and women and people of color make up most of the hourly workers, but they're still being underrepresented in management. So at TJX, that's the company that owns TJ Maxx, Marshalls, and Home Goods, they've agreed to the first step of being transparent and will publicly disclose their gender and racial pay gap information later this year. So I'm running out of time, so I'm not going to linger too much on this slide, but Zevin is known among investors for the work we do around criminal justice. So for example, encouraging companies to rethink their use of criminal background checks so as not to exclude returning citizens from employment. We also engage on the topic of prison labor and corporate supply chains, as well as the funding of private prisons by large banks. This slide just shows a few resources that you can use to learn more about some of the things I've been talking about. And with that, I'd like to pass you on to Julianne Zimmerman from Reinventure Capital.
Thank you very much. Thank you, Sonia, and thank you, Erica, and thank you, Philanthropy Massachusetts, for convening us, and thank you all for being here. This has been awesome so far. And I'm going to spend just a few minutes with you talking about the private markets, as Sonia mentioned at the top. I represent Reinventure Capital here in the Boston area, focused in our investment strategy on companies that are led and substantially controlled by women and or people of color. And in that work, we also do quite a lot of speaking and writing about these topics. So in the materials we'll share with you afterwards, you'll find some further links we're happy to point to as well. Just to make sure that we are all on the same understanding, let's talk about the state of affairs in the venture capital community. We have sorry, my screen share is showing me something different than I expected. Do you see the top 6 myths?
In a very small way. There we go.
Let's try this again. No. Okay, we're just going to have to do it this way. So in the venture capital world, about 90%, give or take, of all venture investment goes to straight white US born men from a dozen universities. And moreover, those firms, the companies receiving that investment capital, are concentrated in about a half dozen metropolitan areas here in the US. And let's just say that there's absolutely nothing wrong with those metropolitan areas. There's nothing wrong with those universities, and there's nothing wrong with those men. However, if you take a step back and think about the United States and the population of entrepreneurs in the United States, it defies common sense that 90% of the capital would be concentrated in such a tiny, tiny sliver of that population. And so what we see is that over time, that capital has really, truly been hyper concentrated. And that hyper concentration results in increased risk and reduced performance. But so what stops investors from overcoming that is a series of misconceptions that are deeply rooted. One, the first one that we hear, and I think you heard both Erica and Sonia allude to this, is a misperception that people of color and women represent higher risk as investment prospects. Not only is there a couple of decades now of organizational literature showing that diverse teams reliably outperform homogeneous teams across sector, across scale, across all different kinds of measures, but specifically in high growth, young, technology-based, innovation-based companies, we see that diverse teams routinely outperform white male peers. And that has real impact on both risk and return. Moreover, partially because of the demographic shifts going on in the country, we are already a majority Black and brown country in pockets, in specific places. And nationwide, we will be a majority Black and brown country by 2040. But also because of just entrepreneurs build what they know, and they create the solutions that they see. Women and people of color have different insights and see different opportunities than their white male peers. And so for a host of reasons, several sources have analyzed the landscape and concluded that, in fact, the better opportunities are found with companies led by people of color and or women. There's a similarly deeply rooted myth or misconception that women and people of color don't grow scalable businesses. And not only do women, especially Black and Latina entrepreneurs, found businesses at a much higher rate than their white male peers, but really what we see is that the lack of access to capital is the big differentiator in terms of how those companies scale or don't. And when we look at the growth areas in our economy, we see that those companies led by undervalued, overlooked founders are the ones really at the forefront of future growth. And you don't have to look into the future to see that. Morgan Stanley has looked back over the last several years and concluded that the sector, the venture sector and private equity sector has just catastrophically missed an opportunity set that Morgan Stanley puts in the $1 trillion range. And so the opportunity set is not, it's not a small opportunity, and it's not restricted to lifestyle businesses, as you often will hear people say. We also hear this myth that investing in women-led or Black, Indigenous, and people of color-led companies is a niche. And in order to focus on that niche, we would have to take resources away from other investments, and we would sacrifice returns in order to do so. And again, there's a host of evidence that has been amassed by a wide variety of sources to completely debunk that perception. And TechCrunch, interestingly enough, wrote that, in fact, by not taking these opportunities, in the venture community and the LPs, the limited partners, the foundations and endowments and family offices and so forth who invest in those funds really have missed out. However, the opportunity set is patent, it's robust, and so the opportunity still exists to take advantage of that opportunity. We also hear people complain that there's a shortage of product. There are no investable deals, or there are too few qualified entrepreneurs. We have a pipeline problem. This phrase we hear a lot. I will say to that, we actually have a network problem, in that the venture and private equity community networks are incredibly well cultivated, and they are trusted relationships, but they're extremely homogeneous. And as a result, those networks really can't see or engage or even in many cases recognize the opportunities they're missing. And so in awareness of that, the prominent private equity firm TPG last year made an announcement that they were making an anchor investment in Harlem Capital, specifically to enable them to begin to gain access to deal flow and opportunities they were not otherwise able to capture through their existing network. And by the way, the fund I represent, Reinventure Capital, is raising a fund, and we have tallied among our peers well over 100 other funds focused on people of color and or women, various strategies, various stages, various approaches, etc. And we've heard from others that they've tallied well over 200. So there is a growing and varied and robust set of funds, in addition to the growing and varied and robust population of founder teams. We've also heard people say, well, large and conventional funds are just safer, and we need to safeguard our endowment or our corpus or our portfolio. And again, this is a very widespread and deeply rooted myth. There is, for sure, more cushion available to a large fund that's, you know, $1 billion venture fund. However, that cushion doesn't necessarily translate into return. And in fact, Kauffman Foundation and Silicon Valley Bank, and among others, have found that small funds, including first funds, much more reliably deliver the kind of investment returns that foundations and endowments rely on. And so we also know this from our experience. The predecessor fund to Reinventure Capital returned 32% IRR. And we know that many of our peers, again, similarly, are delivering the returns that in many cases, the larger funds are not. Finally, we have heard repeatedly that funds that have a specific focus on equity, whether that's racial, gender, social, or other equity, DEI-focused funds, simply can't compete for deal flow, because the larger firms, the better known firms, will just take all the good deals. And again, we see that this is demonstrably false. Entrepreneurs, particularly the best entrepreneurs, the ones you really want to have in your portfolio, are smart. And they want more than just investment dollars. They want investors who are committed to their success, who understand them, and who understand the insights and the skills and the approach that they're bringing to their businesses, and who aren't just trying to sort of tack them on to another group. And as a result, in our experience, we have had founders come to us who had term sheets from other investors who wanted to make investments in their companies. And they came to us and said, we would much rather have reinventure capital. We know that you're busy with other deals right now. How long would we have to wait in order for you to have the bandwidth to consider an investment in our company? And when you think about the level of commitment that represents on the part of the founder to choose the investor they want, it really gives the lie to this myth. Finally, this isn't really yet a deeply embedded myth, but we hear lots of people saying now is just not a good time. The markets are unstable and there's so much going on, and we don't know what's going to happen as a result of the pandemic and all the other crises the pandemic is exacerbating. But again, I will say to you that not only do we have historical evidence, and you heard this also from Sonia and Erica, that investing for inclusion and diversity, and particularly investing in new funds when the market is febrile, is actually advantageous. Down market vintages tend to be very good vintages. And not only that, as you've heard me say, the companies we're focused on in this webinar today are the ones that are most likely to lead us out of the current economic mess we're in. They're the ones who are likely to lead the recovery. And you have many, many options to choose from. And there are many instruments, many vehicles, and a full spectrum of ranges of capital commitments at your disposal. So really, there is nothing standing in your way outside your organization. And as you've heard from Erica and Sonia, the decisions to be made are the ones inside your organization about how to go about capturing these opportunities. We will share other resources, as you've heard. And of course, all of us are happy to take questions and follow up with you as you're interested. So back to Sonia.
Thanks, Julianne, and thank you, Erica, as well. So we all signed up for this webinar today because we believe that societal changes on gender and race issues are critical. And we've learned that investing with a gender and racial lens can help protect and grow your foundation's assets. These impacts can help advance women and people of color into positions of leadership and increase their access to capital. It's about supporting development of products and services that are beneficial to women and people of color, and at the very least, not supporting those that are detrimental to them. It's about securing equity in the workplace and financial services and across the economy to improve people's well-being. So engage with Erica on your pain points. Invest with professionals like Julianne who truly care and understand and want to move the needle on gender and race. And importantly, that will also grow your assets safely. So I hope you'll take what you learned today and apply it to your own foundation, because staying still on these issues isn't an option. As we know, the status quo works against women and works against people of color. So what are you waiting for? I think we are almost at the top of the hour, so I'm not sure we're going to have time for questions. All our contact details are in the book, and feel free to also email Philanthropy Massachusetts as well. So with that, thank you very much. Unless Alex, you want to close anything out?
No, I just wanted to say a brief thank you. Yes, 2 questions came in, and what we'll do is just respond to those questions in our follow-up email to everyone. So we just wanted to thank Sonia, Erica and Julianne so much for your time and expertise. I know I learned quite a bit during this webinar, and I suspect that a lot of our participants did too. So just wanted to give you all a big, huge shout out, and thank you, everyone. Until next time, take care.
Bye, everyone. Thank you.
Bye.